Stocks continue to show a little bit of a pullback over the last couple of days into today. We filled in more gaps. If you follow me on Twitter, I mentioned these gaps that we had from Monday morning and then Tuesday, and the likelihood of filling those in. Well, we finished that process here today. Now the question is, what else do we have left? Is that it? Is that just a breather? And here we go. Is there more to come? There are some technical signs popping up with these last few days' moves. I'm going to show you what those are and what they mean and what the implications from an expectation standpoint. I'm also going to show you some intermarket relationships that are little seeds of hope that of what maybe some longer term expectations are. So I'm going to show you, break down that. And then our trade idea is a stock that we put on here before the market close with an earnings announcement that we had. We're going to talk about the move, that it made sense, and what it means, and how that impacts the trade that we made in our Market Outlook Live, and then what we do with it going forward from here. So let's go ahead and get started. Today is Wednesday, May the 6th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see a little bit of a down day again today, bringing the momentum line this time down to an extreme low. So this is, in fact, this is the lowest momentum line that we've had, even with the gap higher, the lowest momentum value that it's had this whole time. I mean, it pretty much hit 0.76. This was the lowest one previously. This one not as big because a little bit of a move off of the low, just a smidgen, but enough to bring the momentum line up there, and then the gap to the downside as well. But you can see that, I mean, these two are the two lowest levels, and this is the lowest one. So the near-term line is back above 50, but if this is, just kind of watch to see if it continues to go higher, great, because that's what you'd expect. But if we roll right back over below 50 from this level, this would definitely be a bearish high point because it's between 50 and 80. It'd also be corresponded to a lower high and a little bit of a head and shoulders forming here, shoulder, head, shoulder, forming on the S&P. So if that ends up being a bearish near-term high point, then again, you would expect a bearish near-term low to follow, and we'll see if that ends up being the case. Again, you could probably get a bearish near-term low and still just fill in the space down to that 2650 level, right? That's still Fibonacci resistance zone in this case. So there's no, again, we don't necessarily break the trend until you break through this retracement zone. See, the 78 to 23%, once you get into it, you're in the retracement zone, and you're retracing until you get out of it. So once you break above 31.36, you got a trend to the upside. Once you get below 23.26, you're continuing the trend to the downside. So until then, we're just in space. Even in this retracement zone, even outside of it, in these kind of areas, these are kind of the warning zones that we're either going to reverse to the upside or we're going to reverse to the downside. But even there, you still have this low point here. That would be a level to watch for on any pullback, and we'd have to break through there. And I've been mentioning for probably like a broken record. You're probably tired of me saying it, but I think that's a gap that's still open to be filled, right? That's more of a common gap there. Our runaway gap is this one. That was our significant about 3 standard deviation move there. This one didn't quite get to that level. It was over 2 standard deviation size gap, but not big enough to justify this idea of a runaway gap, especially because we didn't have a significant bearish move going into it. That one-day drop is not necessarily a bearish trend, and that's what runaway gaps do. They reverse trends. Breakaway gaps, which this could also be, would be something that's the continuation of a trend. But the problem here is we weren't breaking through any resistance levels on that gap, right? If we would have opened up above these highs and then moved higher, now it's a different story. But we didn't. We didn't break up through those highs. Essentially, filled a gap from a couple of days ago with an overnight trading session, and still that it remains to be a good chunk of the gains. I mean, we have this gap here, this gap which hasn't been. There's a little bit of a gap there, but this gap here that was just barely filled in, and then of course that gap that was barely filled in that next day. So when you had this rally here, a lot of that move was overnight. to get to this point, and that's since then we've been sideways. Slight bullish bias, but we've been sideways. So that's the move we're on. That's the kind of market rally we've been on, where a good chunk of it has occurred on very light volume and overnight trading. Despite that, the posture is still strongly bullish. So any near-term weakness that we get would just be that as of now, until, like I said, we break through anything more. Even if the intermediate line fell below 80, it would still be light pink shading like this, and not necessarily back to dark pink just yet. We'd have to fall all the way back below 50 in that case. We are. We'll get to the VIX here in a minute. If the VIX were to make a run back up above that 105% mark, then we start looking for the intermediate pullback again. 115, 125 or other levels for market sentiment pullbacks, but which we already have, right? So the market sentiment line here below 50. So we'll just keep our eye on the VIX as it does roll over. Now the Russell 2000 was more bearish throughout the day. It already has the light pink shading, so its intermediate line has fallen. Its near-term line barely getting above 50, and its momentum line also at extreme lows for the second time in the past week. So again, we didn't hit any extreme lows during this rally, and now we are. So a little bit of a red flag that we might be getting close to the end of this run, right? We might consolidate first before making. You notice we are still in that retracement zone between the 38 and 62% levels. But keep in mind, if the level here is 1245, and we're pretty close to that one. We're still a little further away on the S&P, but we're pretty close here. And of course, we can fall all the way down to 1150 and still be okay. The Nasdaq's a little different story. If I were to take a look at the Nasdaq, you can see how bullish it is. If you take a look at it, it did break through its 62%. The only major average that did break through this high point. But again, you're not on a bullish trend until you break that 9150 level, and we're not quite there yet. As bullish as the Nasdaq has been, we're not quite breaking through, like in this case, this old high point. Still acting as a resistance, but we held up. It was up today, whereas like the Russell was down. This was up. But again, it's further widening this gap in performance between especially the QQQs, which is a big chunk of the Nasdaq composite, especially on a market cap weighted basis, versus the small cap index. These 2,000 roughly, it's not quite 2,000, but roughly 2,000 stocks at the smaller cap weight, the smaller businesses. So this move higher, which is fine because a lot of the bullish trades we've been making have been in this category, so we're fine continuing to ride this leadership up to the upside. But the problem is we've seen that story before. That story has been bullish this whole time. It started to go parabolic at the beginning of the year, and instead of fixing itself during the decline, which is what typically it does during declines, the relationship got worse during the decline. And then on the subsequent bounce, the Russell 2000 is not what bounced the most. To try to catch up, the Qs bounced more until those last few days. The Qs bounced more, so the bubble, the outperformance got even worse. It went even more parabolic through the down and the bounce back up. So we're not really seeing the action we want to see to have a good sustainable run, right, for a longer period. Now, can we get 98, 99 into early 2000? We had the similar bubble. In terms of Q's type stocks relative to the small cap index, and it lasted a year plus. So who knows how long something like that can last. The CAPE ratio is very similar now to where they were in the late 90s. 96, 97 is about where the CAPE ratio is now. But again, we know how that story ended. That story ended with about a 3-year-long bear market. Are we ready for that kind of market environment right now? Or at least a year from now would be ready for that kind of market environment. All right, so we don't necessarily want this to be the story that continues to play out per se. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do the video again tomorrow. It's a quick way to give us feedback. Whether you like our videos, you like us to keep doing it, let us know. This with one click right now, If you don't like our videos, then you don't have to click on anything. You don't have to watch either. So it's a nice thing. While you're down there too, you can comment. And what did you get out of our videos? What are you learning? Why do you like them? What would other people get out of them that they watched? Go ahead and comment down below on that. Join our website at marketscholars.com. There's a link popping out top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Also, if you're watching us on our blog, we invite you to check out our classes over here on the right. You get access to all of our classes with our monthly subscription, all 8 of our trading rooms. You also get access to our live Market Outlook trade review videos. So all the trades that we do in these videos, we actually put on before the market closes. We do it during this live session. We also review all the old trades and continue to manage them all the way up to the time that we close them. So again, you can get access to that with our monthly subscription plan right here. You get information on both of our plans. If you click on the word pricing, you can see a comparison between the two, and then you can click on either one of these to get some more details about each one individually. We also invite you to engage with us here on social media. Click this heart. It opens up a new window. Hit the like button. Also hit that thumbs up. You can do one or the other or both. Again, the benefit to us is the more likes and engagement these posts have, the more Twitter and Facebook will promote our content to all of our followers that we have. The benefit you get is they will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here so that you can always see our stuff. All right, let's get back to the charts here. Let's take a look at the long-term chart, the weekly chart for the S&P 500. Again, you know, it's this concept of getting a higher high, a higher close, and no lower shadow. And so far, we're failing at all three. We had a pretty decent move yesterday, but we've erased that. Now we got 2 more days left, but it's looking more and more like that's going to be a transition candle. Now, you know, we've seen other transition candles turn not turn into anything, right? Because again, that next week there, we did get a higher high, a higher close, and no lower shadow. So you know, there is still, I mean, the transition doesn't necessarily mean we have to roll over as long as that next week ends up being a really positive week. But being at multiple resistance levels here with that trend line and the 50-day moving average, it is a little bit of a concern that we're not quite out of the woods yet. You know, I know as bullish as we are, you know, you look at the long-term market forecast here, and I know we're not done with the week yet. The intermediate line is just barely above 50, so we got the dark green shading, but we don't have we don't even have a yellow line, much less a green line. And you know, that can take some time, as you can see. It can take weeks, and then you get this kind of bounce back here before you really get going and bullish. But still, I mean, that's how far we are, and we're already, see here, we made a straight shot, maybe 1 or 2 little solid weeks, but we made a straight shot back up to that yellow line. Here we made a straight shot, but in the last 3 weeks, we've gotten some bearish weekly candles. We got a little harami pattern with a long lower shadow, which is not as bearish as a shooting star candle with a long upper shadow. And then now, like I said, you get a potential transition candle on the Hakinyashi. It's just something to keep a heads up on. And you know, as bullish as tech stocks are, and as we've seen some stocks here today and really take off, you know, that's just a little bit of a sign there that, you know, we might not be really as bullish as we think. One of the things that stands out too is this trend indicator, which measures advancers versus decliners, but then compares that ratio to a ratio of advancing volume versus declining volume. So you might have more decliners than advancers, but if you have a bigger ratio of declining volume to advancing volume, then this goes up, which is more bearish, right? If you have a lot more volume on the declining side than you have on the advancer side. And that seems to be the case, considering the breadth of the market. And you can see, you know, that we're rallying up here since we peaked. This is the S&P 500 here, since we peaked a few days ago. So, you know, just a little something. That's the 10-day average. Of course, if you smooth that out a little bit more here, if you smooth out the moving average to be a little bit longer term, so more like a 4-week average, you know, you can see that again, it's rising. It's rising at a higher level than what we've seen We're back. In fact, we're at a higher level than where we were at the very bottom here. So again, this is a ratio. So even though the declining volume and advancing volume might be different on an absolute basis than where we were way down here, it's the ratios, it's the comparison of the ratios that is different now than it was then. So again, it's just a little inkling of iffiness about this rally that we've been on. Of course, you look at the 3 green arrows and things look great. 2 red arrows, which you're not going to go up forever. As crazy as the market is, when you are bullish, you're going to have short pullbacks, which typically give you at least the 2 red arrows, right? If not the third one, but at least give you those 2 red arrows, and that's where we're on right now. And even with this little decline we had today, we're a smidgen below the 8-day moving average, and it's actually flattening out. But we're not below the 7. We haven't broken the 17-day yet. So stages, right? You've already broken the 8. The next stage is to break the 17. If that happens, the MACD and the stochastics are both down below their moving averages. So, but they're both still in the upper half of their chart still. So keep that in mind. But I told you before, when we're bearish, the MACD usually doesn't kind of up and down like it does when you're bullish, where it just goes up and down, up and down, up and down, up and down, right? So it usually comes up and then back down and then back up until we get a nice solid slow grinding trend going. All right, now let's take a look at the intraday chart, and you can see filling in the gaps, right? I know I harp on that a lot, but again, it's just so easy whenever you get big moves. We shouldn't get big moves overnight. It should be small marginal moves, and we get the most of the move in the daytime. But if you do get the bigger moves at night, and that was that was more than a 1 standard deviation gap. I've shown you here. If I go to a daily chart, I've shown you this opening gap study here that we have. And you can see that the gap that we had was a relatively large gap a couple days ago, close to a standard deviation. Definitely would have been a standard deviation back in these areas, before we had the big jump in volatility. And then we had a second pretty decently sized gap here. And, we tend to alternate between up and down on these. And so, but these are relatively large gaps. This was a 0.5%. This ended up being more than 1%. Today was more than a 0.5%. We had 6 days in a row here of a 0.5% or higher. That's not necessarily the most, those are not trends that can sustain themselves. Again, you need volume to sustain moves, and again, most of the overnight trading lacks the volume that you're looking for. So they get filled in pretty easily. They get filled in. So we'll see. Like right now, you can see there's a little bit of a. That's better, right? When you have a little bit, because then you can fill that in a matter of like trading range in the early morning, and then go up throughout the rest of the day. That's the ideal scenario. Or if you get a little lower gap, you can fill that in on the way up. So that's kind of what you'd like to see. You don't want to see most of the upward move already take place before volume kicks in. And you can also see too that day with the big volume, even the regular trading session was really, really light. So you had a big move in the early on, extremely light. And then you had the regular trading session end up with really light volume and not very much of a movement by the end of the day. But not much of a body because we closed near where we opened. And then you can see, of course, today with a little bit of a bump in volume, especially here towards the end. So remember, we still have this gap here to fill in. That's still a common gap that that I think people will, if we fall another 10 points here, that'd be a pretty significant move, about 4% roughly. That would be a pretty significant move and be uncomfortable for a lot of people. But again, it would just be normal. It'd be very, very normal for the market to make that type of move. And for that matter, again, remember 2650 is where the bottom end of that retracement zone is. So it can come all the way into here and still be just filling space. There's a low point over there at 2650 or 265 on SPY. So this would all just be considered filling in space, not really trending one way or the other. So, but again, because of the size of the range, the size of the space, and how high the volatility is, that would be uncomfortable for a lot of people, and there'd be, people will be talking about whether or not this is the peak and we're rolling over, and it's just a space filling move is all it is. The difference is now that the space is getting a little bit smaller. You can see if we get down to 265, we'll be below that lower band. So depending upon how fast we fall, we'd start filling in that space gap there. Then there'd be 265 right in this area. We'd start to fill in some of that space, but we'd also be below the lower band. But that's on the Bollinger Bands. If you look at the other volatility type band, would be the Keltner channels. You would also be kind of flirting with the lower end of that one, right? That one doesn't fluctuate as much as Bollinger Bands because it's based off the ATR. So you kind of get an idea that if we did fall that far, we might not bounce up as nicely and quickly as some people might like us to do. We might hover in this area for a while, maybe even test, which would be my worst case scenarios heading down there. Of course, things would change if we broke through there, but I think as of right now, my expectation is, in a worst case scenario, that we'd come down and test these lows around 24.50, where that 23% retracement line is, hit that and bounce back up at that point. Again, I don't know if we'd bounce back up like that, right? But at least we would start to trade within that lower end of that retracement level, and we wouldn't be breaking down again. But I don't think we'd be bouncing up sharply either. We got to consolidate in this area for a while, in my opinion. Let's take a look at the volatility. I wanted to show you the volume, today's volume, and see this is that volume of that gap. You can see the volume's really tapering off big time, and so is the trading ranges. I mean, the ranges have been below 5 points, 4.68, 5.54, 4.77, and this is 4.68. So we're really dropping pretty sharply, which means one of two things. We'll either keep dropping sharply, and this will make a move down to 2%, or we're going to start getting 3% plus ranges here. So we're talking like 8 points. Just a little bit above where we're at right now, so maybe 8.5 points, ranges. So not nearly as big as some of these. These were tremendous ranges, and that's what spiked this up as big as it did. But still, 8.5 point ranges would be pretty significant, and that obviously would mean that we'd be at least moving down to 26.50 in that scenario, and that would keep us above 3%. Remember, I've said before that generally when you have these spikes, we test this 3% level, and then we form the low point, right? So wherever that low point is compared to this one's, who knows? But at some point in time, we'll form the low point that we'll come off of and make a little bit longer term run. Ideally, in that scenario, we get a little bit more of a pullback in the Qs relative to the rest of the market. And if we don't, then we might not bounce up as much as we'd like. But if we do, then we can have a decent run into the end of the year, second half of the year, into the early part of next year. Finally, let's take a look at the volatility index. As bearish as we have been these last couple of days, not a big jump in volatility yet. We are still relatively low point, and we're making our way back into the bearish territory of this ratio here, which would be above 95%. Again, getting back up to 105%. If we did it really quickly, if we made a big jump up there, then expect the intermediate line to pull back below 50, right? So we'd have enough of weakness that we'd get. This depends on how far. If we pop up to 100%, then we might get some light pink shading. The intermediate line falls below 80, but not necessarily below 50. So now it's just a matter of how far up are we going to, on the next jump in volatility, how far up is it going to get? Is it going to get back to the 105% mark? If that's the case, then we look for more weakness. If it is only going to get to the 100% mark, then probably not going to get nearly as much weakness, and maybe holding up at the 2650 would be the ideal. If we hit 105, then probably going to pull down towards 2450, if not lower than that. Of course, if we hit the 120 again or 100 higher, then probably going to break to lower low. So that's by far the least likely scenario. I think your more likely scenario is that we hit, again, in the worst case would be to hit that 2450, and we kind of maybe pop up a little bit above the 105, 110, 115 area. We get a little bit more of a protracted decline than what people would like, but it would be better for us in the long run. So quick timeout just to summarize our technical outlook that we have. Again, it's been bullish. We are, kind of pulling. There are some red flags showing up in terms of how bullish we actually are. It looks like, this concept of quote unquote retesting the lows might be in the process of beginning that right now. I've said before that that retesting the lows will not happen nearly as quickly and urgently as this initial thrust of selling did. So, and again, the more likely it happens will depend upon how many people are still on the retesting the lows bandwagon, and how many people think that there's no chance that we'll do that. And where the next low would be. Retesting the lows doesn't mean we have to hit the low or go lower than the low. We can hit higher than the low, even like we did in 29, and still form the low point that we can bounce off of. So, it appears likely that, there are some signs suggesting that we're starting that right now. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll, and then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either we're doing a lot more than retesting the lows, that we might be trending to the downside now, or on the other hand, this is nothing, right? It's just an exhale right now, and we're onward and upward from here. So whatever's driving that opinion, share with the community down below. All right, now let's get back to what's driving this price action, and let's go. You can see the risk appetite that we have, and one positive sign that we've had the last few days is as we kind of maybe look like we're rolling over is bonds have flattened out and gold has flattened out. So that's actually a pretty decent sign. A sign that if there is any change in weakness here, we're not going to be falling off a cliff anytime soon, especially with how overbought and still how extremely overbought the safety trade is, right? Remember how bearish the safety trade was coming into, or how overbought, it was coming into the beginning of this year even. Considering that we've kind of been in this risk-off mode, this veiled risk-off mode since the beginning of 2018, veiled by the outperformance in these kind of high mega cap QQQ type names that we've seen. But if you notice, again, this is just this week. You can see the S&P 500 kind of peaking midday Tuesday, coming down. IWM lagging, starting out. It's a really good move early, but now lagging on the week. And emerging markets holding up okay, outpacing, but developed markets not. They're declining. But that's the positive sign right there. To see bonds rolling over. If I were to take a look at the market forecast for TNX, there is light green shading in yellow line. But you can see how the intermediate line, it's crossed above the market sentiment line before, has been above it before, but this is the first time we've kind of crossed above it outside of the reversal zone. So a pretty decent opportunity that we might roll over. You'd like to see us get above at least this high point, to really say, okay, this, instead of being a pattern like this where we get light green shading, yellow line, we just roll over. We are now return around and we get going like we've seen on other risk asset classes, right? So we got the light green shading, but instead of rolling right back down, we stayed up, and that was a good sign that we would hold. And you would like to see something similar in TNX, that we stay up, we don't come right back down, which would be a sign that it's not going to hold, and potentially we could go lower. In as much as we don't think there might be anything lower, obviously there can be. So that's been a relatively positive sign, just a small little sign. And same thing on crude oil. It made its run up, light green shading, yellow line, and so far it has held up. So that's a good sign. And this is a bullish pattern here, strong bullish posture, oversold momentum line. Market sentiment still extremely low, and the long-term chart doesn't look so good. But there's a chance, and similar to TNX too, there's a chance that we might be in the mode right now where we make a run up to the moving average, which would be really, really good for risk appetite. Whether that ends up being the case or not, and you can see the near-term lines more positive than it's been since last time we hit that long-term. This would be a 30-week moving average. And of course, crude oil, which has had its issues, right, as a contract, it's got a lot of room to run, and its near-term line is higher than the last time when it was close to that moving average. So, long lower shadows, there's opportunities here for risk appetite to start to make a move. Here's long-term bonds, and as bearish as it is, with some divergences going here, looking like it's rolling over. So from that particular case, that actually doesn't look too bad for risk appetite. And if there is any weakness in the short term, this may be what it is. This continuation or continued safe haven exit of the safe haven trade, or unwinding is of the safe haven trade. You can see gold too. Now its near-term line did pull back here on this decline. We bounced right off of that. It declined there in that selling off, but then it rallied. But again, the other key factor in all of this is what the dollar does. Is it going to roll over, or is it going to stay up? And again, if it stays up, that's not typically bullish, right? It's better for stocks to have dark pink shading and a red line on this chart. Stocks make much better returns in that scenario. They can still go up, but the returns aren't nearly as good. And as I mentioned before, the only reason why we're up is because of those mega cap stocks. Otherwise, a lot of other equity asset classes have been pretty negative from that peak from early 2018. So we don't want to see this scenario of dark green shading and green line. We'd prefer, if we're going to be bullish, and not just bullish for like a few weeks, but bullish for like, multiple months, potentially a year or two, we want to see dark pink shading and a red line on this particular chart. We've seen that story play out too, where stocks have really been, the dollar was bullish, and I don't know if it will show on this chart. Let me go how the maximum. I don't think it goes back far enough. It doesn't. But here's, let's go back to 2000. So obviously you can see what the trend was like there. This was the last time that we had a really strong move in the dollar with, a strong concentration in growth stocks and in QQQ stocks. That's, took a while for it to peak, but you can see how the dollar, eventually bottomed, it continued to rise, and this is where the stock market finally bottomed out in early 2003. But you can see during that first part of 2000 into 2001, and then in the beginning of 2002, by July of 2002, we had the big sell-off. Stocks then retested lows multiple times, but by the time we had that sell-off, it was perfect. We had this decline, we had dark pink shading and red line, and we were able to really get going from there. And that continued until 2000, October 2007. The dollar made a lower low after the stock market peaked, but off of that low point there, that's when we really hit the bear market. We were below the 200-day moving average in stocks. The dollar rallied from there, and you can kind of see obviously what happened by March of 2009. That's the move the dollar made. So we don't necessarily want this pattern. We would prefer this pattern to occur, especially when this pattern occurs with this concentration, right? It doesn't lead to a big sell-off, right? This wasn't a big sell-off. That bear market took the big sell-off didn't occur until a couple of years into that bear market. So, but what's worse, a big sell-off that recovers rather quickly in a matter of weeks, or a multi-year slow decline. All right, that's a little bit harder for some people to stomach. All right, now let's take a look at the sector performance, and of course, when you look at the 12 grid, dark green shadings and green lines across the board, but starting to get some more light pink shadings. Industrials and financials are not areas that we want to be bearish, and these are cyclical areas that should be bullish. They don't have to lead. These are the areas that typically lead, but still, we'd rather have some kind of strength in these cyclical areas, and they're showing weakness, and it's not surprising that the safe havens are showing weakness too. Utilities really breaking down there. I remember, again, it's one thing to get this pattern. If we stay down below this, then there's a good chance that we reverse that. So it's really important that we bounce up off of these levels, at least in these two, if not these three. Like, safe havens, we don't expect to lead the market either, but they also shouldn't be like dropping in the bear market modes while everything else is bullish. So a little bit of sign of weakness in these spots. If you look at the comparison again, just looking over the last couple of days here, so we're going to May, this week, the beginning of the week so far. Technology holding up. Energy had a good run with a big jump in crude oil. It since has pulled back. Technology, discretionary communication services also doing well. Healthcare. So it's kind of not surprising what the leaders are. But look at industrials and financials. I mean, they're down. You have these interest rate sensitive areas also down. Staples and utilities and real estate for that matter also rolling over. Materials dropping. They're down. Energy's dropping too, right? It's had the biggest move here. So those are your economic growth sensitive areas, along with these cyclical areas, industrials and financials. Not necessarily the best sign. These areas are holding up, but again, like I said before, we've seen that story play out when these economic growth sensitive areas play out. Small cap, lots of industrials and financials in small caps, they don't do so hot, and these mega caps hold up because of name brands or whatever the reason, momentum, strong trends. And then that story doesn't hold up long enough, for forever, and that gap in performance eventually plays itself out, corrects itself. So for our trade idea of the day, we actually took a look at an earnings trade that came out after hours, and the stock really took off. We did an iron condor on this. You can see where my break evens are on the iron condor. Before the earnings announcement, we had a really good bullish pattern, so that's why I wasn't as concerned about the downside of this. But this really broke out to the upside, which, again, that's a very, very large gap to go into, and not a lot of volume below us. And you can see where that's, if we were at 150, we're at 151.5, so we're pretty much flirting with all-time highs or 52-week highs on Twilio. It's one thing to get all this move overnight. It's one thing to then hold it when the regular trading comes in. And are we going to fill in that gap with volume by the time the market actually opens up for regular trading? That's the big question, right? That's the $1 million question coming in. And again, you can see how bullish this has been, or in this case, over the last, 5 years, I believe. 5-year chart, how bullish really from this level, from early part of 2018. Again, since we kind of started this bear market, this stock has really taken off. One of the cloud computing, but this rally we have getting back up to 151, is this a sign of a breakout? Are we ready now to trade this higher, or is this a sign of we made a strong move up, and is it going to hold? And if it doesn't, then it falls back in the range where we're okay with it to be. So that's the question mark. That's the question, is then, how much do we end up suffering in terms of losses in the meantime? If I were to come a single symbol here and take a look at, there we go, look at its trade, you can see we sold. We still have that long put that's going to close out. This is from a class trade that we did way back when. Kind of a flyer that we've held on to because of reward to risk ratio. But this is the new trade that we put on, selling the 105 put vertical, selling the 145, 150 call vertical. That's our trade. That's where we're at right now. That's the move. So it went from right over here in between these two spots to all the way over here, and making a run up in the overnight. So that's a pretty decent sized move. If it can't hold and we fill in some of that gap, then we get back to where we want. And remember too, volatility is going to drop tomorrow with volatility coming out. You can see how high volatility is. So that's going to drop here and shrink this shaded area up into and impact our vertical line as well, because we are relatively, well, we were negative vega when we first got into this trade. So keep that in mind. But that's going to say, okay, I'm willing to lose, in this case, $510. We're down close to that. So by the time tomorrow comes up, are we going to stay up here and then I get out of the trade and take that loss, or is it going to open up and fill, make back some of that loss, and then set me up for, okay, now I just wait for time for volatility to crunch out of this, for time to just pull that purple line up to the green. That's the idea behind the trade. And again, the upside was the risk, and that's what we've experienced, and we had room to work with, right? That's how much I have for my break even at expiration, mind you. That's how much I have to work with. The downside wasn't as big of a risk. Didn't have as much room to the downside. And even if we do fill in some of this gap, there's still not a big concern at all. In fact, here's the well, I showed you the let me show you the 1-year Bollinger Band. Right, so here's where we're at right now. So if we do start to pull back, you can see it's not going to fall back down to these levels. You got now some big time, which was acting as a resistance before today. If we can break through that and hold it, then we're not going to drop back down towards this level either. So we're set up pretty nicely for this after this earnings. It's a question of whether a 25% move can hold with extremely light volume and overnight trading once regular volume kicks in and some profit taking, potentially profit taking occurs. So again, like I said before, if you want to see us manage that trade till the time that we do close it, make sure that you're checking out that Market Outlook live trade review session that we do. So I'll be managing this trade and explaining what I do and how I do it going forward from here. So again, as always, thank you all very much for watching. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our Market Outlook forums where we can keep this conversation going. So any questions, comments you have, open up a new thread, reply to other people's threads, and let's keep this conversation going. Thanks for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between these videos, and join our Market Outlook Facebook group that we created, as well as our community at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.